All right, buckle up, tech enthusiasts. Today, we're diving into a story that's shaking up the electric vehicle world and Wall Street alike. We're talking about Tesla, the company that once seemed unstoppable, and a prediction that's sending shivers down investors' spines. What if I told you that Tesla's stock could plummet by as much as 50% in 2025? Sounds crazy, right? Especially coming from someone who was once Elon Musk's biggest cheerleader. But that's exactly what's happening. Ross Gerber, a prominent Tesla shareholder who got in early, is now sounding the alarm. He's not just whispering concerns. He's doubling down on his bearish outlook. So what's changed? Why is a former Tesla bull now predicting a major crash? That's what we're going to unpack today. Get ready for a deep dive into the challenges Tesla faces, the controversies surrounding Elon Musk, and whether you should be hitting the panic button on your Tesla investments. This is going to be a wild ride. Let's get right to the heart of the matter. Ross Gerber, president and CEO of Gerber Kawasaki Wealth and Investment Management, isn't just some random internet troll. He's a seasoned investor who made a significant bet on Tesla early on. But now, he's publicly stated that he expects Tesla shares to fall dramatically in 2025, potentially losing half their value. This isn't a knee-jerk reaction either. Gerber has been voicing his concerns for a while, even selling off a substantial chunk of his Tesla holdings, about $60 million worth, last year. He cited concerns about the waning popularity of Tesla vehicles and the impact of Elon Musk's increasingly erratic behavior. Now, he's laying out 4 key reasons why he believes Tesla is headed for trouble. We're going to break down each of these reasons, analyze the evidence, and see if Gerber's predictions hold water. Prepare for some hard truths and potentially uncomfortable realities about the future of Tesla. Reason number 1. Full self-driving, or FSD, doesn't work. Gerber argues that Elon Musk's ambitious timeline for launching a fully autonomous taxi network in Austin, Texas, by June is simply unrealistic. He believes Tesla's reliance on cameras instead of LiDAR sensors, which are used by competitors like Waymo, is a critical flaw. Let's be clear, LiDAR, which stands for light detection and ranging, uses lasers to create a 3D map of the environment, providing much more accurate and reliable data than cameras alone. Gerber is essentially saying that Tesla is trying to reinvent the wheel with a technology that's inherently inferior for true autonomous driving. He states, "We're well behind in robotaxi and autonomy. There's no question now," and goes on to say that Tesla will run into a wall because they can't improve without changing the hardware. This is a major blow to Tesla's narrative, which has long positioned FSD as a key driver of future growth and profitability. If Gerber is right, and FSD fails to deliver on its promises, it could seriously undermine investor confidence in Tesla's long-term prospects. The implications of this are huge. It is similar to the conclusions drawn in the paper End-to-End Deep Learning for Autonomous Driving by Bearish et al. 2016, which highlights the limitations of relying solely on camera data for complex driving scenarios. Next up, Elon Musk is distracted. Let's face it, the man is a whirlwind. He's juggling Tesla, SpaceX, XAI, posting on X, and oh yeah, being a father to 11 kids. Gerber argues that Musk's divided attention is hurting Tesla, especially considering his recent obsession with AI. His 100% focus is on AI, and that's really a detriment to Tesla more than it's a plus for XAI and all the other businesses because he doesn't work at Tesla anymore, Gerber claims. Think about it. Tesla needs Musk's full attention to overcome the challenges it faces in the EV market and to finally deliver on the promise of FSD. If he's spending most of his time on AI projects, who's minding the store at Tesla? This is a legitimate concern. A CEO's focus is crucial for any company's success, and if Musk is spread too thin, it could have serious consequences for Tesla's performance. The question is, can one person truly lead multiple groundbreaking companies simultaneously, or is something inevitably going to suffer? This is a problem of resource allocation, specifically, the allocation of human capital. This problem can be modeled by the multi-armed bandit problem. Reason number 3, vehicle sales are slowing. While Tesla has been riding high on investor hype surrounding its autonomous ambitions, the reality is that selling cars remains its core business. And that business is starting to face headwinds. Last year marked Tesla's first annual decline in EV sales. And while management is forecasting a return to growth in 2025, Gerber isn't convinced. He points to increasing competition from BYD, the Chinese EV giant, as a major threat. She has made it very clear that he wants Chinese tech and EV companies to succeed, not Tesla, Gerber says. BYD is such a good company. Everybody in the emerging markets are buying BYDs. But it's not just competition from China. Gerber also believes that Musk's close association with President Trump is alienating potential customers. Remember Sheryl Crow? She famously sold her Tesla in protest of Musk's political leanings. And the Financial Times recently reported that Tesla's January sales plummeted in key European markets like France, Germany, and Norway. We've got to sell cars, and people just don't want them anymore, Gerber concludes. This is a harsh assessment, but it highlights the very real challenges Tesla faces in maintaining its dominance in an increasingly crowded and competitive EV market. Finally, reason number 4. Tesla trades at a premium valuation. Tesla has always commanded a higher valuation than other automakers and even its mega-cap tech peers. But if its vehicle sales continue to slow, that premium could evaporate quickly. At a $1.1 trillion market cap, Tesla is nearly 5 times larger than Toyota, despite generating only 20% of Toyota's profits. And its forward price-to-earnings ratio is sky-high compared to other tech giants. Gerber argues that Tesla's vulnerability is that it could drop by 50% if things don't work out this year. He states, "So we sell Tesla stock. We still have tons of it, and we sell it because we think it's pretty overvalued." Even Wall Street firms like JP Morgan are expressing concerns, with some analysts predicting a potential 60% downside for Tesla stock. The core idea here is that Tesla's stock price is based on future potential, specifically the promise of FSD and massive growth. If those promises fail to materialize, the stock could be in for a rude awakening. This is a classic case of market expectations exceeding reality, and it's a dangerous position for any company to be in. It is important to note that the capital asset pricing model, CAPM, is used to determine the expected return on an asset, but it is less effective when applied to Tesla due to the company's high growth rate and risk profile. Now, let's shift gears and talk about another tech giant facing its own set of challenges, Intel. While Tesla's future is being debated, Intel is potentially on the verge of a massive transformation. Recent reports suggest that Broadcom is considering a bid for Intel's product business, which designs and markets its chips. This could lead to a major shakeup, with Taiwan Semiconductor Manufacturing, TSMC, potentially taking over Intel's manufacturing and fabrication arm. For years, Intel was the undisputed leader in the chip industry, but it's fallen behind rivals like AMD and NVIDIA in the crucial AI market. Intel's attempt to create a foundry business, manufacturing chips for other companies, hasn't been successful. So, spinning off its foundry arm could be a game changer. TSMC's expertise could help the fabrication arm thrive, while a merger with Broadcom could revitalize Intel's chip design capabilities. This is a bold move, and it could potentially unlock significant value for Intel shareholders. But it's also a high-stakes gamble that could reshape the entire semiconductor landscape. Speaking of shakeups, let's take a quick look at the political landscape. Former President Trump is facing a series of disappointing poll numbers early in 2025, with approval ratings plummeting after his first month in office. A recent CNN poll showed that less than half of Americans approve of his performance, while a majority disapprove. Other polls from The Washington Post and Gallup paint a similar picture. Trump, unsurprisingly, responded on Truth Social, claiming he won the election in a landslide and has the best polling numbers ever. But the reality is that a significant portion of the country believes he's exceeding his authority and hasn't done enough to address pressing issues like the cost of living. This early political turbulence could have implications for the economy and the markets, especially given the uncertainties surrounding trade policy, inflation, and immigration that Liz and Saunders, Charles Schwab's chief investment strategist, highlighted. The political climate is definitely something to keep an eye on as we navigate the complexities of 2025. In other news, there's an interesting development in the energy sector that could impact the future of data centers. One and Chevron have announced a partnership to build a new company focused on developing scalable and reliable power solutions for U.S.-based data centers. They're aiming to build the first multi-gigawatt scale co-located power plant and data center, utilizing U.S.-made GE Vernova natural gas turbines. The initial projects are planned for the Southeast, Midwest, and West regions of the U.S. This initiative is driven by the increasing demand for power from data centers, which are essential for supporting the growth of AI, cloud computing, and other data-intensive technologies. By co-locating power plants and data centers, these companies hope to improve efficiency and reduce costs. This is a significant step towards creating a more sustainable and resilient infrastructure for the digital economy. Finally, let's take a look at an interesting partnership in the health tech space. Medirum Healthcare Technologies has teamed up with Elamatech Corporation to boost the distribution of its Mother Bracelet, a health monitoring device that doesn't require recharging. Elamatech is investing in Medirum's series of funding and will leverage its extensive network and expertise in electronics to expand the product's reach. The Mother Bracelet is designed to continuously monitor various health metrics, providing valuable data for users and healthcare providers. This collaboration highlights the growing trend of using wearable technology to promote proactive health management and improve patient outcomes. It's exciting to see innovative companies like Medirum developing solutions that can empower individuals to take control of their health. So, what's the takeaway from all of this? Ross Gerber's bearish outlook on Tesla is a wake-up call. While Tesla remains a groundbreaking company with enormous potential, it faces significant challenges. The success of FSD is far from guaranteed. Elon Musk's attention is divided, competition is intensifying, and the stock's valuation is stretched. Whether Gerber's prediction of a 50% stock drop comes true remains to be seen. But his concerns are certainly worth considering for any Tesla investor. The key is to do your own research, assess your risk tolerance, and make informed decisions. The world of technology is constantly evolving, and it's crucial to stay informed and adapt to the changing landscape. What do you think about Gerber's predictions? Are you bullish or bearish on Tesla? Let me know in the comments below. And don't forget to like and subscribe for more in-depth analysis of the latest tech trends. Thanks for watching.